Afternoon. We're going to continue getting reaction from economists as well as political parties a little bit later on in the bulletin, just to advise you about what the ministers have been saying in that media briefing that took place a short while ago. One of the projections was that the South African economy may shrink by about 5.8%. The IMF Monetary Fund World Economic Outlook will be released later today. And they show the global economy contracting by about 2.9%. Let's find out how that relates to us. I'm crossing now to Ian Cruickshanks. He's a chief economist at the Center for Risk Analysis. Thanks so much for your time on SABC News. Talk to us about that interest rate cuts and what it means for both people who are indebted and who have savings in South Africa.
Yes, it will certainly help them. There's no doubt about that. If you take it an average mortgage of R1 million, you could probably be saving close to R1,000 a month. That's a considerable contribution to spending power. In addition to that, many people have got car loans, and you could get perhaps half that again to be saved. So it's a real contribution that could be made in cash available, either to pay off existing loans quicker, which is what we would recommend, or else at least have a little bit more leeway in spending power for average expenses. This could make quite a difference, a significant difference to the economy as a whole. But if you ask us for contributions to how it should be managed, by all means, yes, have a little bit extra in your pocket. But really, the most important point is try and get debt down to a lower level as soon as possible. And this is a wonderful opportunity with the interest rate on existing loans being less of the total repayment. It means that outstanding loan could be repaid slower and give the opportunity for advancement overall, personally and in the economy as a whole over time.
Has the response from the South African government in terms of economic relief been sufficient so far?
Well, it's going to make a difference as far as government is concerned, because government has a lot of outstanding debt in the government's name, and that means that they will be paying less on the interest rate on that. It's come down by 1%, and that runs into millions of rands a month. So it will make a very material difference to government standing as a debtor, and also to the amount it may have available for other projects in the budget.
With so much volatility and so much uncertainty as well, are we able to perhaps look into the future and project what the South African economy will look like perhaps in a year?
Wow, that is very difficult. What I would like to say is there are a lot of expectations that lower interest rates are going to promote lower spending, and higher spending. But what we have to say is the confidence level, whether it's amongst consumers, you and I and Mr. Average person in the street, or whether it's business confidence is at a multi-year low. So with that situation, we're not going to find a lot more fixed investment. There's not going to be a lot more erection and start-up factories and new businesses. So it will take some time before it has any recognizable, identifiable impact on the economy as a whole.
So we're expecting regulatory requirements, I'm quoting from the minister's briefing here, to release lending of up to 550 billion rand into the economy and a reduction of capital requirements of 30.7 billion in capital and a reduction of liquidity requirements. How much will that aid and counter the problems that you've just spoken about?
There's no doubt it will make a difference. It will be less expenditure from government, and that's important, depending on whether, of course, they say, well, we were going to pay that much in nominal terms. Now we'll still carry on with that, but a lesser amount of that will be in interest. That remains to be seen. But I think basically it means that there should be less for there should be more for government to have available for fixed capital expenditure, and that would be good for a foundation for a better, stronger economy going forward. What I do think is one proviso, and that is there are lots of expectations that we're going to have a V-shaped recovery that is come down very quickly and go up very quickly. What is also quite possible, if we don't get that confidence factor reintroduced, that it becomes an L-shaped recovery. It's got to come down and stays in that lower level of activity for some time. I think that this is a very real possibility, and that is why the average person must be very careful about living within their means, cutting their coat according to their cloth, not being extravagant because they have a little bit extra in their current expenditure savings to just go out and blow it. Rather, continue to pay down debt and to live conservatively, because I think that that's the way we can get the country to go ahead and the government as a whole as well.
Ian, government is looking to implement phase 2 of the economic policy response. If you had the ear of the finance minister, what's the most important thing that you would say he should do?
I think I'm having difficulty hearing you, but let me just say the most important thing that we would advise government to do is to pay down existing debt, the same as we should be for our own selves, to live within our means, to say, look, we have an opportunity of cutting the deficit. This is a wonderful opportunity. We can raise funds at a slightly lesser cost. That means the outgoings on outstanding debt, one of the biggest items in our annual budget, is going to be more manageable, and this is what we should really concentrate on. So pay the debts off first. That's the most important recommendation that we could make.